Welcome to our webinar, Cash Flow, Where Did It Go? Brought to you by CFO OnDemand of Fitzpatrick, Bongiovanni, and Kelly. Please support our sponsors, McPeak Wealth Management Group of Wells Fargo, Ansero IT, Levin Stoller, Attorneys at Law, Allegra Marketing, Integris Investing, Tim Pashley, Cooper Levinson, Attorneys at Law, Rich Asset Management, Ocean First Bank, Sturdy Savings Bank, Bank of America.
You've worked hard to establish your wealth, and Eric Rich can help you preserve it.
I'm Eric Rich. I know you've worked hard to accumulate your wealth. At Rich Asset Management, our sole focus is helping you plan for income during retirement. Call us today to learn how our enjoyable retirement solution may help you optimize your retirement income. As independent advisors, our recommendations are based on our clients' needs and goals. I will serve you by maintaining the highest standards of integrity in the industry.
And now our presenter, Lou Bongiovanni.
Hello, this is Lou Bongiovanni. Thanks for joining us. Before I get started, I want to address three quick housekeeping items. Number one, I want to make sure you can hear me. If you're listening to me through your computer and the sound is not ideal, you're welcome to call through the telephone and you'll get better reception. Number two, one benefit of a live webinar is the participants can send questions. You're welcome to email me questions along the way during the webinar. The way that you do that, there should be a button on your monitor, I believe on the top part, that you can click on and type in a question to me. I will be the only one who sees the question, and I will allow time at the end of the presentation to answer all questions. And the third item is all registrants will receive a copy of this webinar so they can see it again if they like, or share it with coworkers, or share it with other business owners, which I encourage you to do. Okay, let's get started. The webinar objectives this month is, why is cash flow more important than profit? We'll go into that in depth and have you understand how cash flow works and how important it is compared to profit. How do you measure cash flow? We'll talk about the different ways in which cash flow is measured so you have a better quantifiable understanding of it. Why you can't grow without cash flow. Many companies look to grow, however, they're stifled and sometimes they just don't understand why. We'll address how cash flow plays an impact on that. And lastly, a takeaway for you, the 7 ways to improve cash flow. So what is cash flow? Cash flow is the tracking of cash payments relating to all activities into a business and out of a business. So that's the cash that flows through your bank accounts in your business from all sources, whether it's revenue from your business activity or loans from the bank or from yourself. And it also measures the outlay of cash, paying your normal business expenses, repaying loans, and paying distributions to you. There are 3 different categories of cash flow. There is the operating category, the investing, and the financing category. So it's important to understand these 3 aspects of cash flow. So from the operating, that measures the cash inflow and outflow to run the business operations on a regular basis. So this is the normal activity that a business does. This is paying your bills, paying payroll, paying normal expenses. And it also includes the inflow, which is revenue from your business operations. The investing section of the cash flow analysis deals strictly with PP&E, is an abbreviation for property, plant, and equipment. So that's if you're buying trucks, if you're buying equipment or furniture, or if you're making investments. They're considered non-current assets. that section deals with just that aspect of your business expenditures. And lastly, financing. That measures the cash inflow and outflow if you are borrowing money, so that would be the inflow, or if you're repaying debt, that would be the outflow. It also deals with the equity section, which is if you, as the business owner, are lending the company money, or if you're receiving distributions. So these three categories of cash flow make up your cash flow analysis. So why is cash flow so important? Why is it something that should be looked at? Well, cash flow is important as the other financial statements that you're familiar with. So if you liken the statements as the human body, you would say that the balance sheet is the skeletal frame, the income statement is the muscle, but the lifeline of a business is its cash flow. It's not easily seen, but it's critical to having all the moving parts of the business work properly. We'll look at a cash flow statement in a couple of slides, but what you'll find that the cash flow tells you is that it exposes any operating inefficiencies, or it allows you to see operating efficiencies in a business. So it'll tell you if you're paying your accounts payables too fast, or if you're not receiving your accounts receivables fast enough and your revenue. It also provides investment limits. It'll tell you whether or not you can afford that capital expenditure that you're looking for, whether it's a piece of equipment or a truck or a building for that matter. And lastly, why the cash flow is so important is it helps you determine the proper amount of manageable financing or manageable debt that your company can bear. Bankers rely heavily on that aspect of the cash flow because it helps them feel comfortable if they're lending a business money that the business has the wherewithal to be able to satisfy its debts. Profit versus cash flow. Over the years, I've seen a lot of confusion between these two because people sometimes mistake profit for cash flow. And the two are similar, but there are distinct differences. Profit, as most everyone in business understands, is revenue less your expenses, and you find that on your income statement. However, to arrive at cash flow, there are certain aspects or certain differences that need to be taken into consideration once you start with profit. Things such as paying down the principal on your debts, the category of depreciation, and distributions that you pay yourself from the business. These items are the most popular examples of items that need to be used to adjust your profit to arrive at cash flow. So cash flow is the operating cash in and out of the business, less the investment that you make in the property, plant, and equipment, less any financing, which is repaying loans from the bank or from yourself. The big three financial statements. As I mentioned before, the statement of cash flow is one of the critical financial statements in a business. People are familiar with the balance sheet, which tells you in one point in time what the business assets are, cash, equipment, and such, less the business liabilities, which are its normal debts, as well as debts that may be owed to a bank. The income statement people are even more familiar with in business. That shows the revenue of the company less its expenses. It tells you how profitable the company is. However, the statement of cash flow tells a story that the other two cannot. It's probably the least understood and least appreciated of the financial statements. It would be considered the middle child of the financial statements. However, it tells a question of sustainability for a company, whether a company can sustain its activity and have the cash flow it needs to move forward. So each of these statements tell a different aspect of a business to a reader and are very critical. We're going to drill down more into the statement of cash flow in a minute and explain how it does what I just described. So there's two different approaches to this cash flow statement that I'm mentioning. One is called the direct method, and the other one is the indirect method. And I only tell you this in the event you might see it in two different ways. The direct method is by far the least common. It is where the statement of cash flow presentation shows all the cash items coming into the business, less all the cash flow items going out of the business. You would think that would be the more common, because it seems logical that you can see the flow, but however, the indirect method is indeed the most common format in which a statement of cash flow is shown. And the way that the indirect method is presented is it starts with the net income of the company right off of the income statement and then makes adjustments to arrive at cash flow. Now let me demonstrate. So this is a sample of a statement of cash flow. It's one that's generated from QuickBooks. All accounting software can do it. Since QuickBooks is by far the most popular accounting software for small business owners, I thought getting a sample from the QuickBooks would be useful. So here, using my pointer, you see the different sections I mentioned. Here's the operating activity, here's the investment activity, and the financing activity broken out. As I mentioned in the previous slide, it starts with the net income of the company right off of the income statement, and then adjustments are made, mostly to balance sheet items, to derive the amount of cash flow from operations. So in this business, it had $2,091.53 of profit. However, its cash flow from operations is $7,611.73. It has that much more money in the bank, not $2,000. Now, when the numbers are higher, people don't tend to care as much. However, when it's flip-flopped and the number of cash flow is lower than net income, that's where the questions start coming in. But in this scenario, it's showing that the amount is higher. One of the primary reasons is this amount here, this Wells Fargo credit card in this example, shows that a credit card was charged, but it hasn't been paid yet. So there's still cash in the bank account because they haven't paid that credit card bill. So that's the operating activity. This number is incredibly important to lenders as far as showing what the available cash is from the day-to-day operations of your business. The second section is the investing activity. In this example, this company bought a truck for $10,000. So you would see it here as the investing. It's not a normal operating activity, so it doesn't go up in this section. It is here. Then the third section is the financing, which, again, following this example, they bought a truck for $10,000 and they borrowed the full $10,000 here in order to do it. So that's where you see a positive number because cash came into the business for $10,000 theoretically and then went right out to purchase the truck. The $2,256 also in financing is funds that the owner contributed into the company. So overall, this section shows a positive $12,256 because that's how much came in from for this period of time. The end result is the net cash flow is $9,867, which is the sum of the operating, the investing, and the financing. There was a beginning balance of $5,500, so the ending balance per the bank statement and per your balance sheet is the $15,367. So you see how this statement marries the income statement and the balance sheet to tell a story as far as where the cash flow went. An offshoot of the statement of cash flow is a concept called free cash flow. This concept is used by publicly traded companies very often and by individuals who look to purchase or sell companies. Free cash flow tells the user how much cash is available from a business for whatever period of time it's looking at after it pays its normal operating expenses, which is demonstrated here. It has net income of $750,000. Its cash flow is $790 because there is adjustments, less what it invests, what equipment it needs to operate. So free cash flow would be the sum of the $790, which is cash flow from operations, less cash flow from investing to arrive at the $635,000 in this example. So the free cash flow for this business for this period of time is $635,000. So an investor or potential purchaser or seller would be able to say, okay, for that, with that $635,000, I could either pay down the debts of the company or distribute to the owners. I have the freedom to do either, but this is how much I have to work with. That's a very critical number, especially if you're looking to potentially buy the company. You want to know what kind of options you have as a new owner. Next, how do you measure cash flow? And I introduced you to the statement, or maybe reintroduced you if you've seen it in the past. But what do you do with this statement once you have it? Well, first of all financial statements, whether it's the balance sheet, the income statement, or the statement of cash flow, are most valuable when they're compared to something else, a statement from your company for a different period of time or against a benchmark company. When you look at just a financial statement alone without comparing it, it has little value. Well, the same is true with the statement of cash flow. If you just look at the statement that I showed you without any comparatives to that same period of time, let's say the year before, then you really have no point of reference as to whether the business is doing better or worse. So the first way you measure cash flow is you compare it between different periods or different years. The second way is to compare it against benchmark industries. There's a lot of information out there. We subscribe to a great deal of it that shows what the ideal companies in your industry and your size should have in cash flow. Many of our clients like to see that, so they see how they compare to their peers of similar size. And lastly, the most popular way of measuring cash flow is by using ratios, select ratios called liquidity ratios. I'll give you 3 popular examples of them. Okay, so cash flow ratios, also known as liquidity ratios. The first one is the quick ratio, or they call it the asset test. That's when you take the cash balance of a company, you pick a period of time, let's say it's year end, you take its cash balance, you add to it whatever the accounts receivable number is, which is accounts receivable is invoices you sent to customers that they have not paid yet. And you add those 2 numbers and you divide it by the current liabilities of your company, which the current liabilities are normally your accounts payable, any short-term debts that you might have, or any payroll taxes, sales tax, things of that nature are current liabilities. And you develop a ratio. And that ratio is compared to the industry of your industry and companies your same size, and you can see how you compare to them. The second ratio is frankly the most popular, and that's the current ratio, or the working capital. And that is your current assets, which takes not only cash and accounts receivable, it takes things such as inventory into play and any prepaids. And you divide it by current liabilities, which I described above, which is your payables and your current liabilities. This develops a ratio called a current ratio. This tells a reader what your company's ability is to pay its bills under normal situations. The asset test above does something similar, but that tells the reader how well your company can pay your normal operating expenses if it's really stressed, if there's some event that happens and you have limited resources, can you still pay your bills? That's why they call that the asset test, and this one is called your normal working capital test. The last item is your cash flow coverage ratio. Banks look at this very hard, or an offset of this very hard. This is your operating cash flow, paying your normal expenses, over your total annual debts. So they want to know how much of your operating cash flow is available to pay your existing debts, and if you're looking for additional financing, can you pay the additional amount that would be due with you borrowing more money? So this is very critical. Actually, this is so critical that when you get a loan, they ask for a debt coverage ratio, which is very similar to this, more so from the lender. They don't ask you to hit certain net income targets or things of that nature. They want this particular ratio hit, and that is true for every loan you will see. That just gives you an idea of how critical it is to a lender. Cash flow fluctuations and challenges. So now that you have a better understanding of what cash flow is and seeing it on a statement and knowing how to measure it, how does it come into play from a practical sense? Right? You have a seasonal business that is very common in this area. So if you have a seasonal business and you have a busy time and a downtime, many seasonal business owners learn after a couple of years how much money they need to get through the slow season. That part is that number is very critical for them, because they want to make sure that during the slow time, when revenue is not coming in, that they're able to pay their normal bills and activities. And many of them do improvements during that period of time. Okay. Normal annual business cycle. Many businesses have annual business cycles. For example, a business such as mine, business such as ours has a busy season and a non-busy season. So with that, you want to make sure that your cash flow is available and looked at so that you can allow for the slow times that might happen before a busy time. So for example, if you're a retailer and let's say the Christmas holidays are a very busy time for you, there might be a need for cash prior to that period of time to build up inventory. Knowing and understanding when you need the cash is very important to a company, and making sure that things such as a line of credit, which we'll talk about in a second, is available to you. And lastly, owners' personal cash flow needs. You must take into consideration for small business owners the fact that the owner has a cash flow need that he pulls from the business. And as a result of that, that can have a dramatic impact on the company itself, because the company can generate a certain amount of cash flow. However, if the business owner or business owners need more cash flow than the business can support, I've seen where business owners have choked a successful business because they demand too much cash flow from it and do not allow a proper amount of cash to sit in the business in order to have it fuel its growth or there in times of crisis. So it's important to have a good feel for what the owner's cash flow needs are compared to what the business can support. Let's talk about the 7 ways to improve cash flow. Number 1, sell obsolete or excess equipment or inventory. You want to sell poor functioning equipment. Many times when businesses are struggling, they tend to hold on to equipment, not wanting to invest in new equipment because of the additional capital expenditures. However, what I seem to find is that they spend more time on repairs and maintenance of the equipment, and frankly, more time in labor in order to keep it functioning. You want to look at that area to see if it makes sense to sell poor functioning equipment
to actually help cash flow in the long run. Second, sell underutilized equipment. Many times when businesses have some fluctuations or a downturn, they want to hold on to equipment, whether it's trucks or other pieces of equipment that they're not utilizing fully, with the thought that when business turns around, they'll more fully utilize it. I rarely see that working effectively. It's better off to sell the equipment while it's still in good use and get some cash flow from it, as opposed to holding on to it. In this day and age, with the way that technology advances are, it's rare that the equipment is as useful as it could be once that downturn maybe is turned around. It's much better to sell off the equipment. Dispose of obsolete or slow-moving inventory. This is shelf space. So if your inventory is not turning around and being utilized, then you want to move that along, whether it's discounts, you want to offer fire sales just to get rid of them. You want to have fresh functioning inventory. And if something doesn't move, and that happens from time to time, you should just take your lumps with it, get it out and move on. It's just a fresh start financially as well as mentally. And there's opportunity costs that are also lost here if you do not move inventory along or equipment. There's things that you could be doing, but you're still holding on to the past strategies here. It's just a fresh start. Number two, require deposits on large orders. If the nature of your business is such where you get large orders either on a regular basis or on occasion, construction is a good example of this, you want to request a down payment to cover your initial costs. You don't want to be in the hole when you're starting on a larger project. You might be excited by the fact that you did get the large piece of business and want to move forward, but if you do not receive a deposit up front covering that cost, you strain the other aspects of your business while you're focusing on this larger project. I've seen this happen many times with a deposit that really does wonders, and that's just a matter of educating your customer on what's needed. And be courageous. Don't shy away from asking for that deposit. The customer will understand. Also, with that, it's important to be clear on when the next payment event is. Usually, if again it's a construction, there's usually a certain phase in it where a next payment is due. You want to be clear with that in your contract and make sure you keep good internal tracking records of that. The client's busy, they might not remember. You can't rely on them to remember when that next event is. That is on you, and you want to make sure that you get paid promptly. And lastly, the benefit of doing this is you reduce the risk of a customer negotiating upon delivery. They might, if you wait until the very end to pay a large amount and they haven't paid along the way, there might be a tendency on the client's part to want to renegotiate the dollar amount since it's so far away from when you initially discussed the purchase price. Item number three, provide early payment incentives and late payment penalties. This is very useful when you have a large number of transactions especially, and you want to improve your cash flow. So early payment incentives are based on your industry norms and timing. Depending on what type of industry you are and what's accepted, you see this more and more. For example, if you're a seasonal business, and let's say you're in the amusement business, there might be a pre-season sale where you can get things at a discount. That's very normal, and that's done on a regular basis. You see that locally here on the boardwalks and such. That's a good example of it. However, if you're one where you're purchasing inventory on a regular basis, you also see that as well, where there's incentives to early payment. So what you want to do is if you're invoicing somebody for a service or a product that you're selling, and you want to offer them a discount, one common one, and there's all different ones, is 2%, 10, net 30. That one is where you offer a 2% discount if they pay within 10 days or they owe the full amount in 30 days. What's important with this when you're offering those kind of discounts is that you have a prompt invoicing, because you want to start that time, that 10-day period or that 30-day period ticking as soon after you provide the product or service as possible. So invoicing promptly really is something that is very helpful, and I see this as a flaw with many companies. They just do not get their invoices out timely, so that 10-day clock starts ticking much later than it should. On the other side, late payment penalties. If you have a customer who notoriously pays you late or occasionally pays you late, there should be a contractual understanding up front that there will be penalties or a fee, service charge, if they pay beyond, let's say, if it's a 30-day term. So they receive the subsequent invoice, and they don't pay it on time, there'll be a fee there. From a practical standpoint, I do not encourage you to spend a lot of time chasing someone if they don't pay that fee. The point is made that the fee is there to motivate them to pay on a timely basis. Accept electronic payments. You want to make it as easy as possible for the client or the customer to pay you, either by email or text invoices. You can have their credit card on file. Any way in this digital age that you can make it easy for your customer or client to pay you, you should. There is so much more confidence on the consumer's part in this age where Amazon seems to be involved in so many aspects of our daily purchases, where people are comfortable putting their credit card or being invoiced over the internet and payments being made promptly. So if you have a mobile app or on your website, you want to encourage that greatly. It just saves the time of sending out paper invoices and receiving it. It saves time and money, and it's a great way of expediting your obtaining your receivables. Number 5, manage payments to vendors. So this is you paying to your vendors. So one popular way that's been around for years is just using credit cards. So you might want some airfare miles or some other affinity program where you get benefits. So use a credit card to pay a payable, and then the credit card normally gives you about 30 days to pay it. So that helps greatly. Now, the downside is if you don't pay within that 30 days, credit card interest rates are extremely high. So you want to make sure that you manage that properly. But that's a great way of helping with cash flow. Also taking advantage, this is on the flip side now, taking advantage of any early payment discounts. So I mentioned if you're billing someone to offer, but actually if you're paying someone who's offering it to you, I highly encourage you to take advantage of early payment discounts. So using that 2%, 10, net 30 example, if you owe $1,000 on an invoice and you pay it within that 10-day period, and you save, in this case, $20, that is an annualized savings of 36.5% on that $1,000. You're receiving a $20 discount for paying 20 days early. That's a phenomenal return, and I highly encourage you to take advantage of those type of discounts. They're very popular. Next is cooperative buying. You see this a lot with either franchises or restaurant industry is famous for this, where they join a cooperative buying group to give them more buying power and allow them to get more discounts. I highly encourage you to do that. I've seen this work very successfully with companies, again, primarily in the restaurant industry has been my experience, where there are discounts that are available by joining a group of buyers if it's things that you're going to buy anyway. So if it's Pepsi and Pepsi has one, or Coke, if you can join groups that way and get some steep discounts. And lastly, I've seen this work a number of times as well, exclusive buying. If you typically buy your products from multiple vendors and receive market pricing, you may want to approach the vendor who you favor the most, who you think can handle all your business, and provide them with an offer to become your exclusive supplier in exchange for some sort of discount. That's an arrangement that you can make with your vendors, and I've seen it work very successfully in the right fact pattern. Number 6, utilize a business line of credit, or LOC. You've seen it mentioned that way. So lines of credit are terrific as far as helping a business smooth out its cash flow needs, whether it's due to business cycles, a normal business cycle of when you're slow or busy during the time, or if it's a seasonal business that is completely shut down in the off season. Lines of credit help so that business owners can continue to receive their compensation on a regular basis, and you can continue working through the business and paying your bills on a timely basis, despite there being some lulls in the business. You also can use your line of credit to take advantage of buying opportunities. So if there's big discounts or rips in certain industries where you can get buying discounts, lines of credit are great for that way because they're short-term in nature, allows you to take advantage of discounts, and the cost of the line of credit is small compared to the benefit that you get from your purchases. What you don't want to use the line of credit for is permanent long-term loans. And I've seen this all too often where a company is provided a line of credit, let's say from a bank, with the understanding the line of credit lasts 1 year and the business can use it. And what the business ends up doing is taking out the max or close to the max early on and pretty much has it outstanding for most of the year. If that's the case, there is a flaw there in your operating cash flow because lines of credit are not intended for that. They're not intended to supplement your operating cash flow shortfalls on a regular basis all year long. It's only meant for spot periods of time, which once you get to know your business, you know when you need to tap into a line of credit or not. And then the last point is lines of credit usually have a rest period or a 30-day period where you're not allowed to use them. Again, this gives the bank comfort that you're not using this line of credit improperly as a long-term loan. Number 7, develop a monthly cash flow budget. So while preparing your annual income statement budget, and we've talked about the benefits of that at the last seminar, and I will in future ones for sure, that is an important time. And if you're a calendar year business, usually that's done in the November and December timeframe where you're mapping out what the next 12 months will look like. And usually that's done on a monthly basis. That's an ideal time to do your cash flow budget as well, because as I mentioned, your cash flow starts with your net income and making certain adjustments. And you want to look at the 3 different aspects, as I mentioned before, the operating cash flow section. So if you're looking to expand your company, and you want to see what impact that's going to have to your operating cash flow. For example, if you have to build up your inventory, that's going to strain your operating cash flow. You want to see if you can sustain that. Or if you're bringing in new customers, but their payment terms are going to be such where you're not getting the money initially, that too would have an impact. Second, the investment cash flow section. You want to look with capital expenditures or CapEx. How much do you need this upcoming year in the company to invest, and when will you need that, and see what impact that has to cash flow. And finally, the borrowing and investment needs. So once you determine your operating cash flow and what you need to purchase, then the question is, do you need to incur more borrowing, either from yourself or from, let's say, a bank? And I don't know about your experience, but if you need funds from a bank, that's not something that happens instantaneously. They need the proper paperwork. They need to do their credit analysis, and that just takes time. So whether that takes 60 days, 45 or 60 days, you need to allow time. So if you have a cash flow projection, you can request that information far enough in advance so it doesn't create some difficulties in implementing your plan. So I am a big proponent of budgets, income statement budgets, but just as important is the cash flow budgets of a company. And now a quick recap. The 7 ways to improve your cash flow. So 1 is sell obsolete or excessive equipment or inventory. Just have that fresh start mentality here that you want to move forward and get the business as lean as possible. Require deposits on large orders, again, so that they don't strain the normal operations of your company. Provide early payment incentives and late payment penalties. You want to incentivize your clients or your customers to pay their bills on a timely basis for you. They understand if they're in business, they're doing the same thing to their customers. 4, accept electronic payments. Again, this digital age, there's a lot more comfort in doing that. 5, manage payments to vendors. This is your outflow of cash. You want to make sure you take advantage of any discounts and don't pay too soon if there aren't any discounts. 6, utilize a business line of credit in a proper manner to help with the seasonality of your business, but don't use that as a permanent loan. Maybe look at other aspects of your business that are not working right to fix that. The line of credits can be a great tool if used properly. And lastly, develop a monthly cash flow budget so that you can plan ahead and really take the full advantage of the use of cash flow. At CFO OnDemand, we help our clients utilize these 7 ways of improving cash flow by providing outsourced CFO services. Normally what we see is business owners struggling with trying to advance their business here. And where they struggle is the financial analysis. Cash flow analysis falls right into there. They are puzzled by it and they have trouble making decisions and interpreting it. What we do at CFO OnDemand is we provide outsourced CFO services. So we help analyze the financial information such as cash flow, make recommendations so the business owner can move forward and improve their business and continue to grow it. We believe that business owners should be more than just operators here. They should be business strategists. We feel that a business owner who acts like a business strategist is far more successful compared to their competitors. And we feel that business strategists, we know from seeing this over the years, always be business operators. Now we have a few questions. I just want to take a look at them. Here's our upcoming webinar series. If you give me a minute to answer some questions. Okay, so our first question is, how often should I review cash flow reports and how do I do it? Well, with our CFO clients, we look at the cash flow statements monthly and we compare them to the prior year for the month so we know how the business is doing. I think at a minimum, if you look at cash flow statements quarterly and understand what you're looking at, again, comparing it to prior quarters, that'll be a good first start, is starting to get familiar with those statements and getting comfortable for what they are telling you. Next question. My business is profitable, but I seem to be having some cash flow issues. There's a number of things that could impact it, as we mentioned, but one thing that I would look at is how much funds the owner is taking out compared to what the business can support. That is usually the easiest fix as far as when a profitable company that's doing well is still struggling with cash flow. It's maybe because what the owner needs is more than what the business can provide. That's it for my questions. Well, thank you very much for joining our presentation. I hope you found it helpful, and I hope to see you next month. Thank you.